Hello and welcome. It's Phil Nguyen here from Cash Capital, and welcome to the show today at Success Wealth, where everything we do here is about your success. We've got an exciting show today. We've got one of Australia's top independent analysts here to share his views on the real estate situation and the economy. But before we do that, I want to introduce my partner and the founder of Success Accounting Group, our favorite accountant, wealth strategist, and Miss Lan Nguyen. Welcome to the show.
Thank you, Phil. Thanks for the introduction. And as you can see, today we have a very special guest, Martin North. But before we bring him on the show, I just wanted to quickly share with you guys a special announcement that we have launched Success Wealth in the view to help small business and Aussie Australian business to build their business and protect and grow their wealth. So without further ado, we've invited a guest that will help you to navigate, especially the Australian property market. That's Martin North, and I'll get Phil to introduce him more to our show.
Okay, so I hope you all like our new branding and our new look. I'm really happy with that. What do you think, Lan?
Well, I think green is for growth. Given the uncertainty in the media at the moment, I think green is the way that we need to recover from. And that's why we've chosen green and white, which is a clean landscape, but also a new beginning, because with any crisis, there's always opportunities on the other side. So that's why I think, viewers, let us know what you think as well. That more importantly, because we design with the beginning in mind, and I think this is no better time to do that.
Okay, as usual, just go through our disclaimer. The information we provide from our speakers and in our posts and videos and our live seminars and webinars are intended for educational purposes only and cannot be relied on as advice. So if you want advice, please contact us, especially with the JobKeeper that we just had on. If you want more information around things like that, please contact Lan Nguyen, and the number's there. And please support us on our show. So some housekeeping. So this is an interactive session, so we encourage you to participate. So please, if there's any comments, let us know, and we'll be recording this session so you can listen to it after. There's going to be a lot of really valuable information that you can come back and listen and learn every single time. So what are we covering today? Today, as we said, we got our special guest, Martin North of Digital Finance Analytics. The importance of data and how important is to get your data right, get this right to the source of the information, what it all means, so that you can make the decisions that impact you, your business, and your family's lives. Where we are on our in the economy, and what the Australian property market is doing. And we're going to go through some scenarios later as well that Martin's going to show us about the implications of potential inflation or deflation and what that all means. So I'm very excited to hear that. Without further ado, I would like to introduce our special guest, Martin North. He's the principal at Digital Finance Analytics. Hello, Martin. Welcome to the show.
Thank you very much. Great to be here, and hello to all your viewers and listeners. Nice to be spending some time with you.
Fantastic. Go ahead, Lan.
Okay, so Martin, for those viewers who don't know you well, could you please just help our viewers what you do and what you specialize in?
Yeah, absolutely. So just by way of introduction, I call this hanging by a thread, get your data right? That's my thought as to what the property market is actually doing at the moment. We're hanging on just, right? And the reason that's important is that, the fact of the matter is there's a lot going on, and very often I don't think that people have a really good feel as to what's really going on. Now, what I've tried to do in DFA is essentially get data to help. So this chart just quickly shows you that what I do is survey households, survey businesses all the time, asking them about their financial situation, their attitudes, all of those things. I suck in a lot of other information as well. And all that information together then goes into what we call our core market model. That core market model is our core analytic tool. And from there, what we do is write reports, run a YouTube channel called Walk the World, run a blog, provide a lot of client-specific information, but it's all based on our 52,000 households survey plus the SME survey. So this is a data-driven set of thinking, and that's quite important because I think that a lot of the data that I'm seeing is unique and different. And give you an example of that, we can slice the data all sorts of different ways, by household, by location, by different customer segments, young people, old people, all those sorts of things. And that means that it's like a Rubik's Cube. We can play with the data and look at it. And very importantly, we also create some scenarios, some economic scenarios, in terms of where the economy may be going. And that tells us then what may be happening, for example, to property. So, for example, if I take my property modeling, I take the mortgage stress data, which is effectively looking at how households are coping with their mortgages and cash flows. I take the price trajectory. I take the buying and selling intentions. I take migration data. I take CPI, wages and employment and other economic data, and bang it all into that core model through the various scenarios. And that then leads to the ability to look at a postcode level or rolled up to a region or state or all Australia as to what's going on with home prices. And we create these pictures. So this is a one for a Victorian postcode that basically says there's a range of scenarios and a range of different outcomes that you might see. So this is really where we get right to the heart of what we do. Now, that's important, right? Because if you stand back and think about where we are from an economy perspective, we know that there's huge government stimulus in place. This is a UBS chart that just shows that in the third quarter 20, there was more than 20% of GDP in stimulus. It's dropping to 7. It's dropping next quarter to about 2. It's dropping even more. This is a big cliff. And if you look at the next slide, you can actually see that that also looks at it from a household flow perspective. So basically, there was 14 billion lost in wages, plus 2.8 billion lost in uncorporate business income. Then we've got economic support, job seeker, job keeper, roughly 7 billion each, early superannuation at 9 billion, mortgage deferrals. So net, we've had a cash flow boost of 23.9 billion. But that is now beginning to unwind. And so the question is, in that context, what's going to happen to property? Well, one of the interesting observations is the loan deferrals data. This is from APRA, and it shows that we've got a large number of borrowers, let's say 700,000, about 15% of mortgage borrowers, 19% of SMEs, equivalent to around 250 billion of loan outstanding. And we now know that a lot of those are having trouble with repaying their mortgages. Now, what that basically means is we've got the situation now where we have households who potentially are worrying about what to do with their mortgage in the context of the financial cliff that they're facing. And this is a really big deal, because what it means is that for many people, they're now in the situation where they're not sure what they should do. And this uncertainty is one of the critical issues I want to underscore, because as well as the economic data, we also, in our surveys, which we've been running since 2002, look at the qualitative data too. How are households feeling about what's going on? And that's actually quite important, because what it means is that the situation with regard to what's going on is pretty worrying. So, for example, here's a slide from CBA that shows that, in fact, there's been massive injection of government benefits into the system over the last few months. This is from CBA. And yet, we also know that currently, from a demand-supply perspective, we're actually seeing now less property required relative to the supply demand. That's partly migration. That's partly the issue with regard to other factors like all of this government support, all those things. But the fact is, we've got too much property, and now we've got this cash flow crisis coming. That's pretty important, right? And also, we know that our GDP is down, the savings ratio is up. So many people are saving like Billio. They're also paying down loans. The GDP isn't looking too flash. So all of that is pretty significant. Now, I picked up this slide from Macro Business just to make the point that in Victoria, there is a massive disconnect between the stock of dwellings, which is the blue line, and the population growth, which is the orangey red line. It's fallen through the floor. So we've got a massive supply-demand disequilibrium. That's a really important factor to understand when we try to understand what's really going on with the property sector. Now, another point to make is that if you look at the other data points, and one of the critical points I look at is data, you can basically make up whatever you like with regard to auction clearance rates. That is regarded by many as a leading indicator. I don't think it tells you much at all, actually. So if you go to SQM, they said in Sydney it was 52.9%, whereas Domain said it was 72.2%. Who's right? Well, depends how you calculate it. These tell you very little, particularly on low volumes. So I'm afraid that doesn't tell us much at all. And we also know that more price information is being withheld than ever before. This is Domain information. 4-week rolling average of prices not disclosed. We're up to 24% now of prices not disclosed on any of the portals. That means it's very hard to get a compass as to what's going on. Now, next point to make is that if you look at credit, that's actually sliding down. This is total aggregate credit from the RBA, and yet the money supply is running very hot. Now, that's a really weird situation. Normally, you expect the two to run together, but no, because people are paying down loans. Annualized housing down 3.1%. Owner-occupied housing stronger, 5.4%. Investment housing negative 0.7%, and business and personal also going down. Personal credit is way down. So credit is very weak at the moment. And that's important because credit and home prices are somewhat linked. And there's another quick chart here from Loan Portfolio. This is looking at different banks and what they're doing. So ANZ and CBA are lending a lot. This is the portfolio movements in the month from June to July, whereas NAB and Westpac are lending less, both for investment, which is the orange, and blue, which is the unoccupied. So that tells you again that credit is there, but actually the volume is relatively low. Now, why is this important? It's because of this chart. I've explained, I think, before that mortgage stress is a flow perspective in terms of money in, money out. Mortgage stress has never been higher. So 40.1% of households are now in cash flow stress with regard to their mortgages. That's the highest it's ever been. So remember what I've said? There's a cliff coming. There is significant pressure on households and mortgage stress is high. So I can take that further into more detail, but what I might just do is just check in and make sure that I've still got the rest of the audience with me. And if you want to pause and ask me a question, or I can continue with the next part of the show. What do you want to do?
So, Martin, you mentioned a few things that was very significant. So when you say 41% cash flow mortgage stress, what do you define as mortgage stress? Is that so that understand?
Yeah, so mortgage stress is cash flow, money in, money out. So basically I interview a household and basically I say, tell me about what's going on with what you're spending each month, what's coming in each month, so money in, money out, right? And basically my calculation is if they've got more money going out than coming in, they're in stress. And if they've got a mortgage, then they're in mortgage stress. If they've got a rent, they're in rental stress. If they're a property investor, then they're investor stress. The cash flow measure is the best way of understanding how households are. Now, they may have assets, right? They may hold deposits, they may hold credit cards, they might have properties they could sell, but on a cash flow basis, and you'll know as an accountant, cash flow is king, right? This is the best way to get a sense of how households are. So it's a cash flow measure. And what we're saying is 40% of households have insufficient funds coming in each month to manage all their outgoings, including their mortgage.
Well, that's a significant number, and
never been higher.
So you expect that if they, if there is, I know you've got a slide that forecasts like if there is another wave or continue, then that number will go even worse to 60-something%. So that's really
could well. Yeah, no, this is an early, and this, the reason this is important is this is a leading indicator, right? Most of the current metrics that are out there are loan defaults, right? Which is a long way down the track, and the defaults are still quite low at the moment, right? Mortgage stress is upscale of that, looking at what happens upstream, right? And I'll give you an example. There's a postcode called Mandurah in Western Australia, right? And I was looking at mortgage stress rising over the last 3, 4, 5 years, going very high. And then we started to see defaults rising. Then we started to see negative equity. Home prices in Mandurah are down 38% now. And there are social issues. There's druggies on the streets. There's a set of consequences that follow from this leading indicator. It's by far the most significant indicator, I think, out there of what's really going on in the economy. Unfortunately, the official statistics mask a lot of stuff. For example, the Reserve Bank looks a lot of data from mortgage-backed securities, right, and tries to work from there. But the mortgage-backed securities are selected loans put into a pool. They don't actually tell the full story, firstly. APRA only reports on individual loans. It doesn't report on household finances, where my perspective is looking at households and household finances. And that means that we've got a unique lens here, which is really, really important at the moment.
Okay. Now,
Mark.
so I've got another question. And then, so is it more your data for households, home loans, rather than investors? So are we
everybody?
Everybody?
I've got it for everybody. So I can quickly go through a couple of, I'll just show you a couple of glimpses of the data perhaps for different types. So let me just start with mortgage borrowers first. I'm going to put the full screen back on. There you go. So this is the mortgage stress by state. And you can see there that the highest proportion is in Tasmania, but Victoria is second with 44.2% of households who are borrowers. Now, there are 986,000 borrowers. There are 437,000 in stress, 25,000 risking default, right? That's pretty high. New South Wales is a bit below. And in fact, 7,000 were added in the month between July and August. So that's the first way that we can look at the data. And that the reason that's important is because we can actually track it more granularly as well. And let me just show you another picture, which gives you a little bit of a different view, because we can look at it by postcode and we can look at it by geography. This one here is actually the stress data for Melbourne. And I'm focusing on Melbourne because you're based down there, right? The orangey areas are high stress. And you'll see that there are a lot of areas around the east side of Melbourne and to the north. These are postcodes where you've got more than 89% of households here registering as mortgage stressed. And in these areas, you are already starting to see home prices slide. Whereas in some of the others where stress is a lot lower, in the blue and in the yellow, less stress means essentially less pressure on home prices. So this is also a leading indicator as to where prices may be going. But as I mentioned, I don't have data just for owner-occupiers. I have it for renters as well. So here is the rental story, and you can see there that 43.8% of households are in rental stress in Victoria. That's 460,000. Very significant, and just second behind Tasmania in terms of percentage, but a bit below New South Wales in terms of number. Now, that's quite important because what you can also then do is begin to ask questions about, well, where is that stress? And this is really very, very important to understand because one of the really interesting factors here is that we're seeing rental stress in similar areas to some of the mortgage stress. So, for example, if you go into Hoppers Crossing areas like that, there's high rental stress at 65.6% or 7,400 relative to other places, or the Dandenongs at 57.7%. So what you see quite often is a correlation between rental stress and owner-occupier stress in those same postcodes, not least because there's often people of similar types, some renting and some borrowing. And that's a big deal because what it means is that there's downward pressure on property investors and there's downward pressure on owner-occupied borrowers. And the third element, which I can just quickly share with you, is the property investor stress. And here, I'm now looking at property investors, and this is basically where they live rather than where the property investments are, just to be clear. But you can see there that 25% of property investors are stressed and 24.9% in Victoria, or of the 728,000 rental property owners with 804,000 properties for rent, 208,000 are stressed, and some of them are severe stress. So we've got cash flow pressures wherever you look. You've got cash flow pressures for owner occupiers, you've got cash flow pressures for investors, you've got cash flow pressures for renters, but it's not uniformly spread. And that's what my map tried to illustrate, right? You have to go down to granular levels to really understand what's going on.
Martin, you've got a indicator that you call lifestyle indicator. How's that different from some of what you just went through?
Good question. So yeah, we can. Let me just roll back, and I'll just pick up this one here, right? Yeah. So I think the segmentation information is quite interesting. I told you I slice and dice it different ways, right? So I look at young growing families, battling urban, disadvantaged fringe, multicultural, all of those. And look at this. This is actually for rental stress, but it's relatively similar for mortgage stress. Young growing families, so first-time buyers, are at 74.3% of those in rental stress. The owner-occupied stress is quite similar too, in terms of very high. Then we've got a lot of people around the edge of town in disadvantaged fringe and the battling urban. The disadvantaged fringe are those new estates on the outskirts of town. That's where a lot of significant pressures are. Then you've got a few other groups. One interesting one is these exclusive professionals. This is the top 5% of the population. And you've also got young affluents, not so adversely stressed, but this exclusive group, 123,000 and 36% in rental stress. The same is also true for owner-occupier. And the interesting thing about these exclusive professionals, particularly if you look at those with mortgages, they have some of the biggest mortgages, often cross-leveraged on multiple properties, owner-occupied and investment property, big lifestyles. And they've got massive pressures now because their incomes are being crushed and they're not used to it. Whereas some of those other segments like battling urban and disadvantaged fringe have always been in difficulty. So we are seeing some of the significant rises in stress amongst some of our most affluent households. And that is a really big deal, not least because banks traditionally have been very willing to lend big dollars to more affluent households. And I have a feeling that that is where the cracks are going to start showing quite soon.
Okay, so thanks for sharing so much research that you've done, and it's up to date as well. And I can see you specifically target for Melbourne, because a lot of our viewers are from Melbourne, Victoria, who are in a state of lockdown still, very much. Could you tell us or share some insight for, I guess, for the property investors, like what? So if you're already in property, if you have already a portfolio, what should they be doing right now, given the view that you just shared with us? I mean, you can't sell really at the moment because it's. I mean,
property investors, of course, rely on capital growth, right? The critical thing about property investing is your expectation is long-term capital growth. Now, I wish I could tell you that there is a really good story about capital growth, but let me share this chart with you, which is actually for Victoria 3000 postcode, right? This is actually looking at units, okay? And this is the data that we have showing what capital has done over the last few years. So 475,000 was the average price in 2013. 450,000 is the average value now in 2020. And you can see that there were, not bad growth for a couple of years, but if you look carefully, you can see that there have been a number of years where effectively in growth terms, there's been no growth. And in fact, the average gain is 0.2% minus over the last 2013 to 2020 per year. And if you overlay inflation, then they're actually below minus 2.2% per annum. Now, if you start from the predicated view that I have is that it's all about value, growth, and there's no capital growth, what do? Well, then you have to come back to saying, okay, so what about the cash flow? What's the money in? What's the money out? How am I doing? And interestingly, in my surveys, only about 40% of property investors have any strong sense of what their cash flow is. They don't include often some of the net costs. So for example, strata fee costs, repair costs, all of those things, right? And it's all because it's predicated on capital growth. But if there's no capital growth, then the property investment conundrum gets really, really serious. Now, often people will have multiple properties and one will be cross-leveraged to the next, to the next, to the next. And in a rising market, bingo, everybody thinks it's wonderful because you're making multiple leveraged bets. But the reverse is also true. If property prices are falling, then all that unwinds. And that's what I'm seeing in some areas. So I think particularly portfolio property investors, need to get to understand the profile of those investments in more detail. They need to look at a cash flow. They need to understand money in, money out. Rents are dropping, right? So what's the average drop in around Melbourne? Well, in some postcodes, we've seen rents fall between 5 and 8% over the last few months. And that's obviously partly to do with COVID. It's partly to do with no students. It's partly to do with no Airbnb. But the net result is that many people are seeing their revenue from rents falling. Now, okay, interest rates are lower, and the mortgage, therefore, is perhaps less of a severe problem as it was. But these other costs, these management fee costs, these strata fee costs, all those other things that you have to go on paying, maintenance, they're all still there. And for many people, about 60% of property investors nationally, they are underwater on a cash flow basis. That's a big deal.
I agree with that, especially they start as negative gear in the first place. So as a strategy to reduce tax, which I cringe all the time, because really you shouldn't a lot of investors start off would buy a property to offset their taxable income, but that's not how you should be investing in your wealth.
Well, you're spot on there. So a lot of people jump at the government free gift of negative gearing, right? And that they build their strategy from the wrong end, right? It's a bit like first-time buyers saying, whoopee, I can get free stamp duty and I can get $20,000 from the government. I must go and buy. No. Those are at the end of the process, the decision chain, not at the start. First-time buyers are being bribed to get into the market. Many property investors have been fooled by the power of negative gearing. And frankly, a lot of people are actually really shocked and surprised when they start taking this apart and start looking at what the money is really, really doing. And I'll just give you one other example, right? It's not all bad news. Here's another example. This is Carnegie, right? Houses in Carnegie, right? And there, the average gain between 2013 and 2020 was 6.9% or 5% per annum after inflation, which is better. So it shows you that if you find the right places with the right types of property, there is more chance of creating some capital growth. But be cautious, because look at this. In fact, a lot of the growth was in 2014 and 2015. There was some in 2017, but there was a fall in 2018, nothing in 2019, and only 3.8% in 2020. If you bought in 2018, or if you bought in 2017, right, you've actually lost money. And that's the point to make. Timing is really critical too. You need to be cautious and careful about when you buy into the market. You can't assume, as nearly half the people in my surveys do, that properties automatically double in value every 7 years. That comes in my survey all the time. I don't know where they get it from. Maybe it's from some of the property portals. It's not true. There is very little evidence to see consistent doubling of values over 7 years. There are some postcodes, some properties, but overall, got to be very careful. This is one of the better postcodes in Victoria in terms of performance over recent times, right? So just want to make the point, and I'm not a property bear, I'm a property realist, right? You need to do the work, you need to understand what's going on in particular properties, in particular locations. Generally, units perform worse than houses. Generally, some of the inner city apartments in particular have been crushed, whereas some of these slightly further out areas are doing quite a lot better.
Thank you for sharing such insight. I want to ask you, are you familiar with the 18-year property cycles? So, and I guess this is there is a group of people that believe that for property does go up in cycles and goes down as well. So it doesn't always go up all the time. So what can you share about that? So we understand where we are at in that cycle at the moment.
Yeah, so there's Phil and Catherine, you probably know them both, right, who both are very, very strong advocates of the property cycle. I do a lot of work with a guy called Harry Dent over in the US, who is also very strong on these different cycles. He overlays a lot of other cycles too, everything from demographic cycles, technology cycles, and even things like sunspot cycles, I think, as well. There do seem to be some predictable elements that come up again and again and again, right? Now, if you take that as roughly right, regardless of what's caused it, and there are lots of different causes at a particular point in time, there seems to be a cyclical view. And therefore, if you take that cyclical view, we are due for a down rather than up over the next year or 2 or 3. I am less convinced on an individual property basis, but if you look at the trends overall, I do think there's something there. I really do. And maybe it's to do with the broader economic cycles that match the property cycles. We had a bit of a crash over in the Northern Hemisphere in 2009 and 10 because of the global financial crisis. We're having a bit of a wobble here, whether it's a mid-cycle or end cycle, according to people like Phil and Catherine. I don't know, but there's something there which I think is important. The point to make is property does not religiously double every 7 years, right? That's the point. You need to know where you are. You need to know where the cycles are. And again, be cautious and careful. That's what I'm saying. Be cautious and careful.
Yeah, they do share that view with you that this is because I followed them as well for a while, and they say that this is a mid-cycle. They weren't aware no one knows about COVID and that, but it just happens to be around this time, and then there's a correction, but then the leg up following the correction will be an upturn. So it's interesting to see that, the data looks, fairly bad and at the moment, but we're still optimistic about the recovery. When that is, no one really knows, but once the prices are deflated, then it's better that way, and it's more better for investors to go in when they're deflated rather than at the top. Always.
Well, you got to pick your time. Look, there's a few things just to underscore there. The first is, if you go back 150 years, there've only been 2 times where prices have actually outperformed inflation. The first was after the Second World War. The second was between 1990 and 2020 because of financial deregulation, cutting of interest rates, the global financial crisis, and the deregulation of lending more broadly, right? That's unusual, right? Second point is prices are 40% over their long-term trend values. So there's more chance of them falling rather than rising from this point. Third point, demand has fallen off a cliff. I showed you the supply-demand disequilibrium in Melbourne. That's consistent across the country. We have no inward migration. In fact, Frydenberg last week, or was it this week, said that there's going to be net outflow of migrants over the next couple of years in Australia. Property investors are sitting on the sidelines because they're not getting the value. Who's buying? Well, the answer is first-time buyers are being cajoled to come in and get those bribes and go buy, but there aren't many of those. Another data point: there's 1.2 million spare properties in Australia. We've got more property than we need. So don't believe all the spiel about we need to build more property. No, we don't. We've got plenty of property. In fact, there's lots of vacant property, and the problem we need is to get that property activated and used rather than actually just building more. And by the way, a lot of the stuff that's been built relatively recently is very poor quality. It's already degrading, and a lot of people who bought new off the plan 2 to 3 years later are seeing their values down by 15 and 20%. So that's a very, very bad investment strategy in my view. I wouldn't buy new at the moment. I just buy old. I think you can do better. Final point is there's a demographic shift here. There are what I call down traders. These are people who are older. These are people who are now moving towards retirement. They have large amounts of equity in their property. They are now saying it's a good time to sell. So we're starting to see them put their property on the market. We're seeing property investors putting property in the market. We're seeing some of those with mortgages who are not being able to restart payments now being encouraged by the banks to put their property on the market. So supply-demand disequilibrium is all over the place. We're going to see more supply coming on. We're going to see, therefore, prices probably slide over the next little while. And I know rates are really, really low and mortgages, are cheap and all those things. But frankly, the supply-demand equation doesn't work at the moment.
So with all that's going to go on, Martin, so we've got, government bodies that try to influence what happens in the economy, like RBA and, fiscal policies and things like that. Like what can the government do?
Well, the government is desperate not to allow house prices to fall, right? And remember that ScoMo gave a promise before the last election that prices wouldn't fall on his watch. Right? So he's got that promise, which he made. But the Reserve Bank is also worried, right? Because this is about the confidence. And I just touch on this briefly, right? This is my household confidence index. And the point about the confidence index is that this tells you how people are feeling. The point is that confidence is as low as it's been. So this is the way to read this is 100 is neutral. Anything above is positive, anything below is negative. We've got a drop to 73.2 when COVID started. It went up, came down, went up. It's now at 76.5. Confidence is shot. And that's true whether you look at business confidence or consumer confidence, right? So the confidence is when people feel that they want to go out and buy stuff and take on mortgages. When confidence is low, the chances are they will do less. And that's very important to understand. So the RBA is desperate to try and get people to spend. And so one of the ways they can do that is to keep interest rates really low. So they're manipulating the yield curve and trying to actually give back liquidity to the banks to make the banks lend more. They, of course, announced last Friday, Freudenberg, that they would change the responsible lending standards next year, get rid of them, making it easier for people to get mortgages, although actually I think that's not going to have a major impact because most people will get a mortgage. So we're in the situation where there is a huge amount of attempt to try and keep prices up. But my data suggests they're beginning to slide, particularly in some areas where there's high levels of stress. And I'm not sure how successful they will be in terms of being able to support the overall momentum in prices. Now, there's another reason why this is important. If in fact prices go down, it means that the value of the security against which the banks have mortgages go down too. And the banks, of course, will have to hold more capital if that's the case. That costs them a lot. And the other point there is if defaults start to rise, then those loans have to be, again, put onto a higher capital rating. So it costs the banks if defaults start to rise. One of the reasons why APRA deferred the need to define a bad loan, when interest and principal is not being paid, that's not a bad loan, that's fine, just carry on, keep rolling, right, until March next year. But at some point, that's going to come to an end as well. So that's why I do believe that there are more down forces rather than up forces over the next certainly 6, 12, 18 months. And here's the key point to make. If you look at the US, and if you looked at Europe, and if you looked at Ireland, after the global financial crisis, prices started to slide. And they went down for 3 to 4 to 5 years and then started to come up again. The maximum defaults, though, didn't start until 3 years later. And in fact, the biggest peak was in year 3 and year 4. This takes a long time to work through. And my own view is that we're going to see prices continuing to grind lower until some of these broader economic issues are actually addressed. And of course, the other factor is we've still got the virus bouncing around to an extent, even if it's under some more control now.
That's not to say businesses are not able to operate at full capacity, and with other factors involved, people losing jobs because of the virus. So that's not a good outlook.
Well, no, and look, the point is, I'm very worried about the small business sector. I think the small business sector had a really rough deal. I don't think JobKeeper was actually a very smart strategy. I think that a lot of it went to the big end of town. Some of those big retailers actually paid handsome profits and bonuses, right? Some of the small businesses found it much harder to get access to JobKeeper. And as a result of that, we think about 1/3 of small businesses are close to the edge. In fact, in my small business service, about 1/3 are saying they might not be around in 6 months. And that's because in the particular segment, and it's tourism and it's retail and it's education, all of those segments, a lot of them are struggling. And many of them are actually owners of property, and they've actually put their property up not just as a mortgage for their residents, but also to support their business. Correct. And I believe that the first cracks will show not in the mortgage sector, but directly in the SME sector. So I'm really concerned about that. I hope there is stuff in the budget to help small businesses through. We need our small business sector to be firing really strongly because it is the strongest creator of growth and the stronger creation of wealth in the economy. And yet at the moment, I'm afraid that from my perspective, government policies, whilst they might pay lip service to the small business sector, they've done very little to assist, in my view. And if you're an innovator, if you've got a new idea in a new business, it's so hard to get funding from anybody at the moment. And you might be able to get unsecured funding at very high rates from some of the neo lenders, but it is really tough. We need a different approach. We need to turn the dial away from just more mortgage lending, right, and turn it towards supporting the small business community, the small business sector, because that is our future. I hope the government does something, but I'm not sure they're going to.
Well, you're absolutely correct, and 4.5% on the unsecured loan for small business to pay back in 3 years. That's triple the the interest rate of a home loan. So the focus for our government is clearly not on small business, as you say, and that's the fabric of jobs and getting the economy back. So and there's nothing so far in the media that they're going to do anything different in this budget. So it's quite disappointing so far. But I think with your saying about a third of SMEs that won't be around 6 months, I think actually it's even higher, because the ones that are not around, but the ones that are still around are not doing so well either. So they're the ones that are still holding on to JobKeeper, and if you're closed for 1 year, Martin, where are your customers? Because these are cafes, not cafes, but sports, and they need that continually in momentum. So,
well, I agree. I got a question for you quickly. Do you think that the change he announced on Thursday, Frydenberg, relating to the way that failed businesses can have a bit of a holiday, right, a month or so to sort themselves out and to get creditors, do you think that's going to make any difference?
No. I think that's a bad Band-Aid solution, a very bad one. And if only they could interview the accountants that are helping, helping these small businesses survive, or even just, because as I said, there are out of, I think 20% are doing good because of the construction work businesses, but 80% are all struggling. And even if they are allowed open fully tomorrow, they're not sure that the income is going to be pre-COVID, to survive as a profitable business. 80%, I think. So there is a big problem for the government to sort out in this budget, and there's nothing in the media right now. And
I think it's disgraceful. You're reiterating what I said. In my surveys, I see exactly the same. And my concern is that essentially we're missing an opportunity here, right? There are many businesses that will go out of existence. The other point is that when they struggle, of course, their network of creditors and suppliers also get contaminated too. So effectively, you find that there are other businesses that are getting dragged down as well. In the world of capitalism, sometimes the best thing to do is to let the business fail and then restart it, rather than just try and prop everything up. I mean, to my mind, the policy settings that we've got, which is to try and support everything and stop everything from falling over, right, was a major mistake, because what we've done is to create a bigger problem down the road.
I think what they've done is they try to save the property market first, because it's lazy and it's easy. Because that's, that would have an immediate effect, but it's not a long-term solution. And so I think we share the same. If only we could share that to the policies makers.
Well, I can tell you something. I speak to politicians all the time, and some of them quietly will nod and agree, right? But they can't say it. So there's a disconnect between the private views of some of those down in Canberra and indeed at the state level, and what is said publicly. And that, for me, shows you something rather concerning about the way that politics is working in this country and how decisions are being taken. I believe that they're being taken partly from a view of just driving more debt. So we're going to throw more debt at people because more debt's the only way to solve. But frankly, we're out-debted already, right? We've already got too much debt in the system. And so just throwing even more debt on is just going to make the problem even worse. What we should be doing, I think, is to redirect investment away from housing towards the small business sector, because that is our future.
And how are they going to pay that debt off? Because it's already how many times of income, to the mortgage now?
Yeah, no, well, it's a great question. So the BIS statistics is like 200%, So, but that's everybody, right? Remember that only 1/3 of households actually have a mortgage. So the true debt ratio is about 6 times income to debt, right? And I know that many people have had loans for a long time, so they're a lot lower. New business is still being written at 6, 7, 8, 9 times, right? Which is hugely way too over the top. And now, of course, the responsible lending stuff is being taken away. So basically, it's all down to the consumer. Basically, if you think you can make those repayments, then the banks will say, here, fine, you can have the loan. There isn't the degree of rigor that I think there should be. I'm very disappointed that the balance is being swung so far back. My own belief is that the banks probably were given a bit of a sweetener to say, well, if you postpone mortgage and interest repayments for a few months, we'll do something on responsible lending. I think that's probably what happened behind. So I don't know, but that's just my theory. Because it just seems to me to be completely out of alignment. You should not be making it ever more difficult for people at the moment trying to borrow. Remember the Royal Commission? The Royal Commission showed all of the bad behavior from the banks and the fact that people were getting loans they should never have got in the first place. That has not fundamentally changed. So we should obviously try and educate people so they make better decisions, and that's part of what DFA is about. But I think those consumer protections should stay in place, and I'll be lobbying very hard to try and keep them rather than actually just allowing them to dissipate next March.
So Martin, just on what you've been saying, the banking system is designed for mortgages and not supporting entrepreneurship and not supporting SMEs, and the ratios are just completely whacked. Can you talk to that a little bit more?
Well, that's exactly right. So if you look at the proportion of bank debt to the housing sector, right, it's about 65% of all lending, right? That is double what it is in the UK and the US. And even Hong Kong, it's in Hong Kong it's 23%. So we've got more of our our banks lending on mortgages than anything else. That's because we've had massive run-ups over the last 20 years, much reduced lending standards, high income multiples. But of course, we've got no income growth. Real income has not grown for most households since around 2012. So we've got the situation where whilst interest rates have come down so that effectively you can get a bigger loan because the repayments have been roughly the same, right? We're just so leveraged. And the next point to make is the banks are also lending and have been lending to the construction sector and the commercial property sector. If you add all of that in, then about 3/4 of all lending is property related, right? Now, if you go back a couple of decades, 60% of lending was for business purposes. Today, it's a lot less than that. So we've got a completely myopic banking system, blessed by the governments in power, both sides of politics, blessed by the regulators, but we've set ourselves up for a massive failure. The economy in Australia is narrowly based. It's basically two things. It's digging stuff out of the ground and shipping it overseas. That's the holes. And houses and holes and houses, right? We need a broader based economy. And I keep saying, I think there is an opportunity here. Now, maybe COVID creates an opportunity for creating a different approach to how we think about the business community and how we invest. We can't just throw more and more money at the housing sector and get more and more people into more and more debt. And you know what they'll do, they'll make 40, 50-year mortgages, right? They'll push more people interest only, despite the fact that 2 years ago they were trying to go the other way. All of these are nutty strategies. It's just that everybody's too short term, nobody's taking a strategic view, and nobody's thinking about the longer term interests of the country, in my view.
So Martin, I saw something on the weekend that really, really surprised me. I'll just put it up on screen. A property in Sydney, they went to auction and was 10 million above the reserve, and it broke records. It was just, I don't know, what's going on? There's a massive disconnect, and I just want to know if there's something that I'm missing. How can this happen under these circumstances?
Well, there will always be properties that will sell, right? And that's a really, really expensive property, right? So this is not the standard, sector of the market that most people are buying in, right? I don't know how many people would buy in that. Very few. Those people are, independently wealthy, probably internationally wealthy, and can buy and sell whenever they want. So this is no indicator of what's happening in the broader market whatsoever. And yet all of the media keeps reporting all of these one-off events, overpriced, over the reserve. I told you earlier on, there are more prices being withheld than ever before. That's a sign of a falling market, right? And you've got to look granularly at different postcodes and different locations. There are some where prices are actually significantly down, units down 30 or 40% in some areas. I mentioned Mandurah at 38%. there are other areas, particularly houses, particularly unique properties, with a great view. There's always going to be some level of interest, international interest probably, as well as local interest. So, but that doesn't, one swallow doesn't make a summer, just because you see the occasional property that's actually over reserved. And every time there's an over reserve, they just put all of these articles on all of the real estate portals and in all the press. It's like everybody's spruiking, right? And the thing I get really frustrated about is that the spruiking has now turned up to 11. It is as loud as it could possibly be, if not louder. But that's a sign of desperation, right? I'll tell you another data point. I was talking to somebody today who's looking at buying a new off-the-plan unit. And that offer was they will get a $60,000 cashback if they buy this place, right? So basically that means that the developer can sell it and claim the price is up here, but then below the line, they'll pass $60,000 back to that individual. So they're distorting the market relative to the true price. And those are the sorts of tricks that we're seeing left, right, and center. I can show you another one where rental stream income is being underwritten for 10 years, right? Anything to try and get a sale. This is not a healthy property market. We've got lots of property developers struggling to complete projects at the moment. There's another 200,000 properties to come on stream. We've got an oversupply of property. So you've got to try and separate the sheep from the goats and try and understand what's really going on from the stuff that's in the mainstream media, what's on the property portals. They're only talking their own book because they want property prices to go up and they want more transaction volume and throughput. The truth is a million miles from that.
And what about interest rates? Where do you see interest rates in the next near term and long term? Do you think it'll just stay low as? Or?
Well, I don't think there's any argument for rising interest rates. The Reserve Bank said the rates will stay low for at least 3 years. There might be some minor movements on some of the fixed rates, but there's a speculation that the Reserve Bank might take rates from 0.25% cash rate to 0.1%. Westpac said October, then they said November, so we'll see. There's even a debate about negative interest rates. My own view is that I think that's a bit unlikely in the short term, but medium term it could, simply because the only tool that the Reserve Bank has is interest rates, right? They really, despite the other things that they're doing, it's really an interest rate story. And there's a limit. But the problem is, if you look around the world, very low interest rates have not solved our problem. It's not generated the momentum in the economy that we need. And my worry is that we'll just see low rates for a long, long time. The other side of it, of course, is that there is competition in the markets at the moment. So rates are very low. That competition may ease later. So we might see some minor movements, but I don't think we're going to see rates rise much at all. Frankly, if they went up 1% from where they are, we'd have a massive collapse because many people just couldn't afford to make higher repayments. So we are in this cul-de-sac of ever low rates, negative rates possibly, and probably a stagflation or deflation scenario, a bit like Japan, is what I'm seeing at the moment.
So, Martin, just to touch on some of the international stuff. So there's the election happening in America coming up soon. I just want to understand how much influence does the American market and what's happening over there in terms of policies come and influence our local market?
No, it's a good question. Look, there's a couple of factors there. Clearly, the US dollar and what happens to the US dollar has a very significant impact on our Aussie dollar. In fact, the recent moves up and down of our Aussie is more to do with what happens in the US, right? So that is a really important factor. The second factor is that in the US, housing is way cheaper, 4, 5, 6 times cheaper relative to Australia. So you can't read necessarily across from one to the other. But what you can say is that the housing sector in the US is booming at the moment. Low rates, of course, incentives to borrow. So a similar strategy of trying to use housing to stimulate. But the other factor is that we are turning off investment into the banking system from overseas investors. In other words, the bonds that the banks were issuing overseas, they're now getting from the government, low rate RBA funding, right? And that means that there's a different balance between international and local funding of our banks. The Reserve Bank is taking the yield curve down, putting significant funding in, and APRA has now said that they want the banks to buy local authority bonds and those sorts of things as part of their liquidity build. That's going to change the supply-demand equilibrium for international funding. And that in turn could have a significant impact. The final point is that if in fact we get an exchange rate at 75 or something like that rather than 50, that's going to have a very negative impact in terms of importing inflation and, of course, devaluing our goods sold overseas. That's going to have a negative impact on GDP. So there's a lot of connectivity points here. But I think the final observation there, of course, it depends a bit on what happens with regard to travel, international movement in particular. And the airlines that I speak with are saying it's going to be 1 to 2 years before they see travel internationally opening again. So I think that's the other factor that's just worth thinking about in terms of trying to understand the broader macro.
You mentioned deflation and inflation and stagflation. So for those viewers who don't know much about that, and how does that impact, I guess, our Australian economy in general?
Yeah, well, that's good. Well, I mean, let's talk a bit about inflation or deflation, right? Because you can basically say inflation, that's basically when the money supply goes up and then you've got more money chasing the same amount of goods, so prices rise. That's what inflation is. And that's because of central bank printing. It's the growth in the money supply, which is very clear here at the moment. A lower Aussie dollar would also support that in terms of importing inflation from overseas. The RBA has a 2 to 3% target, of course, as well. The fact about that is that the rates are really as low as they're going to go. Plus the fact that the policy has been to fuel private sector debt, as we discussed. That's deregulation. I call extend and pretend. Kick this stuff on a bit longer. The Fed, of course, is at least from its words, targeting higher inflation. That came out a couple of weeks ago, although I'm not sure how real that really is. And so the bottom line is that there are reasons to think that it might be inflationary, right? But there are also, observation there. If in fact that's true, then things like gold and other metals could well be a hedge against the loss of value. But there's another side to the equation, and that is that it could be deflationary because the central bank printing, which is what, of course, everyone's now doing, didn't work in Japan, didn't work in the Eurozone, right? It didn't actually help. Bigger money supply may be irrelevant, and we're seeing that here as well. Our money supply is very high, and yet the momentum in the economy is not. We've also got potentially a higher Aussie dollar exchange rate, which imports deflation, not inflation. We've got the target rate. It's going to cut rates to the bone. I don't think negative rates will actually help. That's what the experience in Europe and in Japan is, so that may be true. And policy is also dependent on sector confidence, particularly are people willing to borrow? Are we at peak debt already? Well, possibly we are, in which case all this money printing and all this pushing more money at people to borrow more won't work. And of course, the Fed is targeting higher inflation, but they actually continue to fail. And in fact, their words are different from their actions. And by the way, is QE really money printing? We could have a big debate about that, which I'm not going to do. But the conclusion of that is that if you think the future is going to be deflationary, then in fact gold and other metals might fall in value. Now, this is the really critical dilemma for us at the moment. I don't know which way it's going to go. I can't tell yet. There are many people out there who are very bullish about inflation being the way to go, and it's just a matter of time. But I have a nasty sinking feeling that we could be following Japan, in which case deflation is going to be what we're going to see, in which case asset classes will perhaps decrease in value rather than increase in value. And at the end of the day, I think it's too soon to be betting on one or the other, but other people will disagree with that.
So what can we do now then, Martin? What can we do to prepare for the what? Because I believe, in my opinion, I believe the deflation camp first. But what can we do? What can our viewers do to prepare for the worst to come?
Well, my own view is I think any investment class carries a risk. There is no such thing as a risk-free investment. That's true of gold, it's true of silver, it's true of property, it's true of stocks and shares and bonds. Everything has risks. My own view is be as flexible and agile as you can at the moment. Don't lock yourself in, right? Because it's too soon to understand how this is going to develop, right? So my own view is be really very, very cautious. The second is watch for those leading indicators. I think that things like mortgage stress, as we discussed at the start of this, is a really important leading indicator, right, of what may happen ahead. And there are indicators out there, not the traditional ones like GDP and all the other things that economists talk about. I think some of the stuff that we look at probably gives us a better read on what's likely to happen. The third point is that you need not about to set and forget. You need to be actively monitoring and managing your investment portfolio, which is something you should be doing everywhere. But it amazes me how many people don't. You know, they throw it into a superannuation fund and assume that somebody's looking after it, or they buy property and sit on property and never worry about the returns, or they hold gold, which isn't earning anything, and they worry about its future value. And is it going to rise? Is it going to fall? Well, gold went up to 2,000, came back. Where it's going to next? Who knows? I mean, it's tricky. I think this is the trickiest time, and I've been around for a long, long time. This is the trickiest time I can ever remember for investments, investment strategies, businesses and business strategies, households and household finances. So caution, I think, is the watchword.
You're not letting anything out. Caution. So you mean pay down debt, or any tips at all? Or?
Well, look, my view is less debt is better than more debt at the moment, and that's why many people are paying down debt. I think that's a good thing. But I'm an old school. To me, debt is something you only take when you have to have it, rather than actually wiring it into the way that your life works forever and just saying, well, I'll always be paying interest, right? That's what the banks want you to do, because the banks want you to go on servicing those debts again and again and again for years and years and years and years, right? The most smart strategy is to deleverage, get yourself sorted out. If you've got multiple investment properties, start thinking about that portfolio, looking at them, looking at where the good value is and the bad value is. If you've got stocks and shares, expect a fall. Is my view is there will be a fall from this point. The fundamental valuations are way over. Property is still overvalued. It's going to come back. Tricky times is what I'm saying. That's why actually holding a bit of cash is not necessarily a bad strategy at the moment. Look, and I run multiple scenarios, as we discussed earlier on, right? Yeah. So I basically try and say it's impossible to predict how this is going to play out. But just quickly, this is my scenarios. So there is a future where we're going to see unemployment come back, mortgage stress is going to go down a little bit, and house prices could rise. But I only give that a 2.5% probability at the moment, right? There's also a really bad case of uncontrolled pandemic. Well, I think that's only 5%. But in the middle, you've got these scenarios here where there's going to be some improvement because the virus is going to get under control. We'll see mortgage stress around this level. We'll see losses rising. There'll be small house price losses. Or if we get a longer term crunch, if this broader economic downturn drives more negativity, we see businesses begin to fail, the unemployment rate could be, over the next couple of years, 8.75% or higher. I actually think that's my central scenario at the moment. So all my house price modeling is based on that. And there's also the risk of a second wave still. We haven't got this nailed yet. So what I try to do with my analysis is to use these different scenarios to explore how the market may move and what people might do. And then what I always say to people is test against alternative scenarios. So if you think X is what's going to happen, what happens if Y happens, right? What would that do? And I actually think quite often that sort of experimentation and that sort of thinking through different futures is the most critical thing that people should be doing at the moment. Nobody can predict. Somebody who's very bullish on gold and saying, of course, it's all going to be hugely inflationary, they don't know. On the other hand, if you say it's going to be definitely being deflationary, they don't know either. So you need to have flexibility, agility, and very importantly, watch the data as it comes through, because things are moving very, very quickly. And my view is that within the next year or so, we'll get a much better read on which of these scenarios runs through. My own perspective is unemployment will be certainly 10% by the end of the year by the Reserve Bank, 7% 2 years later. I think that's about right. But I think that real unemployment will be a lot higher. I think that more businesses are going to go under. I think that property prices are going to fall, and therefore people need to be very cautious and careful about what they do at the moment.
Okay. Phil, is there any other questions for Martin? Otherwise, we will ask how people can find you, because you said watch the data that comes through. So
yeah. So Man, what I did was I took the S&P 500 and the ASX and I overlaid it on a chart with the recent crash and this recovery. And like what you were saying, you're commenting on, well, there's so much of the population in things like index funds and things like that, where they're just depending on the market to perform, to get any return. But the outlook's not good. Like, what do you reckon for these people? If because they're just depending on it's. I don't know, it's been a pattern since the last 20 years or the last 10 years where index funds has become so popular that that's all people know.
Well, you're right about that. And look, the fact of the matter is that we do know that a lot of the indices are supported by the tech sector, particularly in the US, right? Less so here in Australia. Our index is more, mining and finance and a few other things here. So you've got to sort of be cautious, I think, about the future. The other point to make is that the long-term value of shares should actually have some equation to what the income earning capacity of those firms are. At the moment, it's not. There's basically been bond buybacks and buying back shares, all of those things that have been happening, right? That can't go on forever. At some point, people have got to wake up and think about, well, what's the true value? And my own perspective is that index stocks tend not to do particularly well over the very long term, but it's tough to call, right? It is, this is a difficult market. There really is a difficult market. I personally like to actually kick the stocks that I have, and look at them and understand the management and do those things rather than give it to somebody else to manage. Some people will make different decisions, but it is very tricky. I do think the markets will come back. I do think that we're going to see more volatility, and I guess the US election we touched on earlier on could have an impact as well. I mean, the China thing could have a big impact. The virus thing could have a big impact. There are so many variables there that it is really very tough. That's why I say agility and being cautious is very important. The final point to make is if you're in these funds, you often have to pay big fees. And I would say one of the critical things to understand is how much you're actually paying for your investments at the moment. Many times people's returns are diluted because of the fees that are being paid. They come off the top, regardless. And when people actually wake up to that, often they find that there's a better alternative.
Wow, so much valuable data today. Thank you so much, Martin. It's been absolutely fantastic. So just to sum things up, I would say really everybody needs a plan out there because we're in uncharted waters, uncharted situations. We've never been, we talk about all the cycles, but this is something completely different, something new. I don't think that all these cycles have met in such a way before.
No, we are in uncharted territory in so many ways. I mean, federal bank, activity, government activity, all of those things. Small businesses never been so badly crushed as they currently are. Households, confidence levels very low. This is very, very difficult to navigate, and therefore, watch for the signs, watch for the data, be cautious, be careful. This is not a time to go out and sportily saying, "Oh, I'm going to buy a portfolio of 10 investment properties because they're a bit cheaper than they were this time last year." That is a recipe for disaster, in my view.
So, Martin, if people want the latest data and want to follow your work, how do they contact you?
Yeah, great question. Thank you for asking that. Okay, so we have a Walk the World channel, is our YouTube channel, Walk the World. There's a bunch of shows there. I have Edwin talking about property. I've got Tarek Brooker, who's a journalist, talking about the broader economy. Catherine Cashmore, who's the cycle lady that we mentioned earlier on. And I also put my own stuff up. So go across there and have a look at that. I also have my blog, digitalfinanceanalytics.com blog, where you can get all the latest. I blog daily on there as well. There's also a Patreon channel that I run where you can get my data. So, for example, if you're interested in the mortgage stress data, it's available by postcode from the Patreon channel. A lot of people grab that and get this granular information like I showed you in the mapping. You can also even talk to me on a one-on-one basis. I run a service where people can actually chat with me about a particular postcode. Very popular, about 3 to 5 weeks out, but I can do very granular analysis too. But the critical point to make is, whatever you do in terms of accessing information, make sure that you don't just take the first piece of information off the mainstream media and just assume it's 100% right. Do your own work, really look at the information, get to know what's really going on, then you can make better decisions. And if DFA can help that, then we've achieved our mission, because our mission is to help people make more and better independent decisions rather than trying to flog stuff.
And perfect, because we're not getting that from the media or the
I know. It's frustrating. I mean,
on the right data source.
No, the mainstream media are not doing anybody any great service at the moment. There are a few good writers still, but mostly they're not, and they're spruiking, and they're a lot of the media, of course, is linked. So the real estate's linked to the broadcast media, that's linked to the print media. They're all cycling the same stuff around. I'm trying to help people make better, independent, objective decisions, whether they're a business, whether they're a consumer, because this is now more than ever is really critical. Make the right decisions now, make sure that you know the right questions to ask, and that's what DFA is a bit about.
Fantastic. So
I'll put all your links to contact Martin at the below the video. Thank you so much, Martin. I actually learned a lot today as well, and I'm sure to pass it on to my clients, that they need to be, our mission is to make sure that they get well financially educated and to make informed decisions with our strategies. So there's no point giving you strategies if you're not having the foundations of the latest data, because you're not going to get it from anywhere else. But Martin North is a good start.
Well, there's always plenty of information, and take it or leave it, but at least listen to some of the things that I say, because hopefully you'll get a bit of a balanced view. And like I say, I'm not a property bear really. I'm just a realist about what's going on.
Fantastic. So Martin, thank you for today, and hopefully we'll get you on the show a little bit time later and see where things have unraveled, and maybe we will have something to celebrate rather than
Fingers crossed.
Fingers crossed. Okay. Thank you.
Thanks,
Okay,
Martin.
thanks. Okay, bye.
Bye. Okay, Lan. Wow, what a day. That was incredible data. Things that I learned so much today. What words have you got?
Oh, I got the word flexibility, agility, and watch the data that comes through. So everyone who's not on, who doesn't have the most accurate data, please visit Martin's site, which we're going to put in the link, because with the right data and the education, then you can make the right choices in your investment portfolio. The data before COVID, if you have a misrepresentation of how to build wealth, then you're going to make wrong decisions. We are very. We probably will invite Martin on maybe after March, when the JobKeeper and everything ends, and then that's when the cliff will definitely see if it falls or not. So there's the information there, guys. So make sure you take a screenshot of that. And if anyone has questions for Martin or myself and Phil, please reach out to us, and we'll see if Martin can answer it. I'll just quickly get to the next slide, please. So now that you guys know that you got to do something, because what you know of right now, this is what you've learned from Martin, is that now is the time to review your portfolio. You need to see that, for your business, you need to plan for a recovery plan, and make sure that your investment portfolio from September to probably the next 6 to 12 months is the best one for you. Especially everyone's got JobKeeper, which is a taxable source of income, and no one's really thinking about how, if you're already making less money, how are you going to pay that in tax? Okay, so that's a taxable source. But secondly, what Martin said is very important. Flexibility. So if you got to do a stress test for your portfolio and your business. Now, if you can only last 2 weeks, 30 days, then maybe we need to reshuffle some of the things of your assets, your liabilities. Okay, because it looks like that this pandemic is not going to go away very soon. In fact, it's going to stay with us for at least everyone knows that, until March to June, and that's if best case scenario. So the other thing is make sure that you're maximizing on the grants on JobKeeper 2.0, which is open for registration today. And therefore, if you are eligible, if you're in that case, then make sure that you watch our webinar last week with myself and Coy. If you are not eligible, that means your business hasn't dropped, but you still need to do work, because as Martin said, there is a lot of bad data coming out so far. So you need to make a good solid plan of how you're going to recover through these hard times ahead. That's sorry, Phil?
Sorry, yeah, and it's not just the next 18 months. We're talking about 3 to 5 years plan here. So let's start thinking, start planning, start building that foundation, and make sure that you got everything in place.
Yeah, and one of the easy things for you, interest rates are dropping, and I think if you're coming out of fixed rates, or if you haven't reviewed your interest rate, the easiest way to reduce or increase your cash flow is to review your current loans for a better rate and restructure your investment portfolio and super investments right now. So I hope that everyone doesn't just think this is just a good webinar and then do nothing, because this is the opportunity for you to, you heard it from Martin, you heard it from us that you need to do something to review and restructure, so that, if the worst case scenario comes, then you are prepared for it. Flexibility, agility, and watch the data. That's all I want to leave with you.
Cool. So that's it. Hope everyone enjoyed the show today. Thank you so much. And, Martin, if you're still there, we thank you again. And Lan, look forward to your next show.
Thank you, everyone, and take care.
Thank you.